Hey everyone, Scott here, and this week we're going to talk about inflation and how it relates to income planning. Alright, inflation has been a hot button topic this year in 2021 as we come out of the pandemic and all the money that was printed last year in 2020 to help keep the economy in check while the economy was basically shut down. So, all those new dollars that were printed and put into the economic system might be causing inflation. And so the last 12 months, we've seen an inflation rate of 5%. That means if you have money sitting in the bank, if you have money just sitting in cash, earning nothing, that money is now worth about 5% less, all right? It can buy 5% less goods and services, all right? So when we talk about inflation rate and you hear about the Federal Reserve talking about transitory inflation, what they're talking about is they don't believe that this 5% inflation rate, they don't think that's going to be sustained. Now, I'm sure a lot of you remember the 70s and 80s when we had a decent amount of inflation, actually a lot of inflation. So from 1970 through the 80s, okay, that 20-year period, prices rose, the CPI, Consumer Price Index, rose 233%. Compare that to the 90s through 2010, the next 20-year period, prices only rose about 73%. And then the last 10 years, they've only gone up about 20. So that rate of inflation has been going down. 70s and 80s, it was high. And now, the last 10 years, it's been low. So the last 12 months, when all of a sudden a 4.99% rate of inflation came up, it has some investors a little bit spooked. And it's something that we're taking a really close look at. So when we talk about transitory inflation, we believe that that means, the Fed believes that that means the rate of inflation will not continue at 5%. We'll still see inflation, okay? That's part of having a healthy economy is prices going up over time. We just don't want it to be 5% year over year because that will have a major effect. So let's look at a hypothetical situation and how inflation will affect a retirement plan. So let's get started on that. Okay, so we're going to look at a hypothetical situation, a 65-year-old who has $60,000 in income, whether it's from Social Security, pensions, whatever it may be. They have $60,000 coming in, and we're going to be generous. We're going to assume that that guaranteed income is going to grow by 2.5% per year, all right? So that's a little bit generous on that side because if you have Social Security, you know that it doesn't seem to keep up with inflation. So we're going to be generous on that side. And I want to look and see, and by the way, this hypothetical person, they have $1 million saved for retirement and they spend $100,000 a year. Okay, so they spend $100,000, they bring in 60, that means they have to pull $40,000 a year off of their investments. Now, let's assume that there's no inflation, okay, 0% inflation. Their expenses stay the same. Now I skipped a bunch of lines. I'm looking 15 years down the road. Well, their income went up. Expenses stayed the same if there was no inflation, which means they have to pull a little bit less. Now what about 30 years from now? At 2.5%, their income has more than doubled after 30 years. Expenses stayed the same if we use 0% inflation. So now they're actually saving money. Now, let's look at what happens to these shortfalls when I just plug in 2.5% inflation on their expenses. All right, that's a big deal, okay? 2.5% inflation, all of a sudden, they're $100,000 in expenses right now. 15 years from now, that's over 40% more in expenses. And 30 years from now, it's double. It's $204,000 in expenses, which means that shortfall, the amount they have to pull out of their investments, goes up pretty drastically over time, even though their income is going up as well. So let's look at what do they need to earn on their investments in order for that to last, because at 2.5% inflation rate, $1 million you can't just have that $1 million earning nothing, because what this is showing is they would run out of money somewhere between age 80 and probably 90. So if I put 1%, let's say this person earns 1% a year, not enough to beat inflation. Does that work? No, because here they are 30 years from now, still don't have enough money. They have ran out of money here. How about 2%? Still not matching inflation, right? Still doesn't work. They're out of money before 30 years from now. How about 4%? Okay, 4% helped, but not a lot of wiggle room. Here we are 30 years from now, and they basically have a little over 1 year of expenses left in their investments. And what happens if instead of 2.5% inflation, what if they had 3% inflation? Okay, they ran out again. Okay, so right there, that is why we have to invest in things that are going to keep up with or beat inflation. Really, we need to beat inflation if our long-term retirement plan is going to work. So some of the specific things that we invest in to beat inflation, we think the stock market is a great place to be long-term to beat inflation. Companies that we own shares of, they're able to raise prices right along with their costs going up. They pass that right along to us, the consumer, and us, the investor, benefits from that. You know, other investments that have the potential to beat inflation over time, real estate, commodities, gold, those are all viable options that we look at to determine, you know, what are the best places to be. Now, we can't have all of our money, in any case, in risky assets, or most of us can't have all of our money in risky assets. And so then, when we're looking for safer investments, we have to look for investments that are going to beat inflation over time, or at least have a chance of beating inflation. And that's right now, that's not cash, that's not CDs. So last week we talked about those fixed annuities. That's just another reason why we use those in the foundation of your financial house, because they have an opportunity to beat inflation over time. So I hope this helped give you an idea of how inflation can have an impact on your retirement plan. Hopefully now you kind of understand the difference between transitory inflation, what that means, what that doesn't mean. You know, it doesn't mean that prices are going to go down. It hopefully just means that we're not going to continue to have 5% a year inflation. If you want to go over this with an advisor, give us a call, 844-CARLSON. Go check us out, carlsonfinancial.com, and go to Carl's Corner and check out any of our past videos. Hope to see you soon, and have a great 4th of July weekend.